Hello, everyone, and welcome to How to Minimize Taxes in Retirement. I am Colette. This is Joanne.
Yes, it is.
I'm Joanne. This is Colette. And we're going to be talking about minimizing taxes in retirement today. We have some fun updates about how we're going to do these webinars moving forward that we'll get to. But this is a live webinar, so if you have any questions, chime them in. And on the right-hand side, there's that chat box. You can type them in as you go. And if you're watching the recorded version of this, if you have questions, send us an email. We're always happy to help with any kind of tax questions that you have. So we're gonna go through this here.
Yeah, and we noticed too as we're updating this, there's just updates in different areas, and they don't always fall under taxes too. So we're going to hit some of those in here too. So it's going to be more of an update of things that are important for you to know. In taxes, it's going to be one part, but there's other areas that we're going to cover going forward.
Yeah. Alrighty. So
not that taxes all by themselves aren't riveting.
Very riveting. Yes. So you guys, most of you guys know us on this call. It's our cute little family here. We have two offices, First Bank and in Centennial. And I'm going to click through these, read that really quickly, all of our disclosures about us not being tax professionals or legal professionals, et cetera, et cetera. And let's talk taxes. We'll take a poll. Where do you guys think taxes are going in the future? Up, down, or staying the same? I know we have kind of a small audience today. A lot of people will be wanting to watch this after the fact. So I'm going to share the poll anyway, though. What do you guys think they're going? Up, down, or stay the same on the right-hand side of your screen? We got up. Okay. Yeah. All right. There's a consensus. Yeah, not a lot of people think that they're going to go down. In fact, we know that they have to go up when the Tax Cut and Jobs Act expires here in a few years, or part of it. So we'll get into the weeds on that. Let's get into the thick of this stuff here. Mom, you want to do a little recap on the Secure Acts Part 1 and Part 2 in case you missed it? You might have missed it.
Yeah, that Secure Act 1 was 2020, and then Secure Act 2 was in December of last year. It snuck in there. And a lot of people don't know the changes.
There wasn't a lot of news coverage about it. So
No. So they're trying to really make things, well, I'm not sure what they're trying to do, make things better, but some things aren't as good. So, for example, when you inherited an IRA in the past, I inherited my father's IRA, and I had over my lifetime to take payments, or I could take it all out. That was called a stretch IRA. But now those things are gone unless the few points here. So in general, if you inherit an IRA and it's not your spouse and a few other things, you need to take that money out in 10 years.
Yep, that's a new rule. They used to let you keep going and going and going, but not anymore. You got to take it all out in 10 years, and it doesn't have to be necessarily scheduled, right? You don't have to do 10% per year to get it out in 10 years.
Yeah, there's a little caveat. They keep changing it all the time. But one thing is, if the person you inherited from already started taking payments, you have to take a minimum payment every year. If they didn't, you can take it all in the 10th year. So there's some planning with that, because you're pulling that out. You don't need it. Say you're still working. You don't want to pull out too much because you're taxed on it. So you want to stretch it out and do it later if you can. So some thoughts behind that one for sure. And then this one is a surprise to a lot of people and a lot of companies, because I know a lot of our clients got letters saying they had to pull out their RMDs, which they didn't have to because they changed the age twice with the Secure Act. The first time they changed it from 70 and a half to 72. So most people think it's 72. You must start taking money out of your pre-tax accounts that you did not pay federal and state taxes on. Well, they changed it again in December of last year. So now the age is 73. So that's neat. I mean, you can take it out if you want to, but you don't have to. Mm-hmm. So anyone who didn't reach, well, here it is, beginning in 2023, this year, it's 73 going forward. And then they're going to raise it again in 10 years.
Yeah, so don't get too comfortable because it's going up again, and it's going to be a little bit different for everybody depending on when you hit that RMD age. So just pay attention because it's a moving target.
Yeah, and just keeps changing. So what's nice is, though, they really did decrease the penalties, which never should have been as high as they are. If you were supposed to take out 10,000, you didn't, your penalty was 5,000. They've reduced the penalties to 25% if you don't take it out when you're supposed to. But if you rectify it fast,
rectify fast means
10%.
If you fix
penalty,
it,
fix it.
If you fix it, if you forgot, but then you pay it, comes down from
you're still going to have a
25 to
penalty, though, so you want to make sure you take it out when you're supposed to. And we make sure we do that at the end of the summer, beginning of the fall. We make sure we contact everyone.
Our clients, not everyone
on the planet, but all our clients, to make sure no matter what they have, we're doing that correctly.
Yep.
So those are big changes. A bunch of other little ones, but those are the big ones. So I wanted to talk about this a little bit because we're talking about taxes. And what we're just going to generally look at what gets taxed in retirement when you're not working anymore, and then what doesn't get taxed in retirement. Of course, there's different kinds of taxes too. You can have ordinary income taxes taken out, or it could be capital gains taxes. So there's two different buckets there. But let's talk about this. What gets taxed in retirement? If you have a pension, that's generally it's federal and state taxes on that. IRA distributions, you take money out of your IRA. That you can withhold taxes. We help people when they're pulling money out of retirement. We help them pay. We send taxes to the IRS and to the state, and they get the net, and then they get a statement at the end of the year saying this is how much you paid and blah, blah, blah. They reconcile it. But you take money out of your IRA, it is taxable. Traditional IRA, 401ks, it's taxable. Non-retirement accounts, so those are not IRAs, just a regular joint account or individual account. If you have bonds, you pay taxes, the interest on bonds, you pay taxes on the dividends and stocks. And I'm saying not that you're selling or buying stocks or bonds, but stocks and bonds pay interest and dividends. So when you get that in your account, even though you don't take it out, you owe taxes on it. Capital gains pretty much is when you're buying and selling something that has a gain. You could hold on to some forever and you don't pay taxes on it. But the moment you sell it, you want to look at what was the value when you bought it versus what you sold it at, and your own capital gains on that. And that's a different set of brackets.
And we've got that later in the presentation because we did have a request from one of our attendees to talk a little bit about capital gains, taxation, and retirement. So we do have a slide on that.
Yeah, and usually it's lower taxes, but we'll show you that in a minute. So security, is that taxable? Well, it depends on if you have other income coming in.
We got lots of slides on that too.
Yeah, so it probably is most of it, but sometimes not. Gains on selling investment properties. That, I see a lot of people selling properties into retirement. And it's not a first or second home, it's an investment property, and they owe capital gains taxes on that. And that actually increases their income, which could offset other things, Medicare premiums and everything else.
So even though they're not paying income taxes on it, it still counts towards the income.
Yeah.
That's a tricky one.
Yeah, they're paying capital gains. But if you buy or sell or anything, we want our clients always to give us a quick call and let's talk about what you're doing before you do it.
Yeah.
Okay, so this is what does not get taxed in retirement.
Roth IRA distributions. We have some slides on that. Lots of you guys have Roths. We love them because we already paid the taxes on them, right? We paid taxes in the seed, so we don't have to pay taxes in the harvest. Interest earned on municipal bonds. Municipal bonds, the state. Expand on that one.
Yeah, they're state or regional. They could be town related. It's just when some government entity is trying to raise money to fund something. So the government wants the money to go there and they want to give you some advantages.
Give you a break.
Give you a break, but usually you don't make as much percent and interest on the municipal bonds because you have break on, you don't pay taxes on most of the interest, especially if it's in the state that you're in. So there's some exceptions, but most of the time, the interest.
And then cash in the bank, unless you earned interest, which a lot of you probably are this year. A lot of people have been opting for those higher yield savings accounts or those CDs. So keep your eye on that. If you got a good rate on any of those products, you'll be paying interest on paying taxes on the interest. Some of your Social Security, we're not going to talk about that yet because that's coming up here in a little bit. And then income less the standard deduction. So
standard deduction is standard, or if you itemize, but the standard deductions are so high these days. So, whatever income you earn, obviously when you do your taxes, that's your adjusted gross. You subtract the standard deduction or the itemized amount if that's greater, and that comes off of your income. So you're not paying taxes on that.
Like our tax buckets here, we'll talk about tax diversification, but we like to separate them into 3 categories: taxable, tax deferred, and tax free.
Yeah, so bottom line is that everything is taxed if you have any gain, no matter what, right? If you buy something and sell it at a gain, you owe taxes.
Unless it's a Roth.
Unless it's a Roth, or the tax-free things here. So, should you want to diversify when you're investing things? You don't need. I mean, it would be great if everything was in a Roth IRA, but that's kind of hard to do because then you'd have to convert all your pre-tax money from 401ks and IRAs into Roths, paying the taxes today. There's a plan to do it. If it makes sense to do it over time, but you want to be able to have money in all those kinds of areas, buckets of taxes, because we really don't know where taxes are going in the future. Probably going up. There's lots of categories of taxes, but it's nice to have some money in a Roth IRA, and it's good to get it started because there's a 5-year waiting period to be able to take out any of the gains.
Yeah, we got some slides coming up on Roths, but we just wanted you to see that there's different tax categories, and of course we're going to get as many things as we can into the tax deferred or the tax free category, just to either postpone taxes or pay them in advance. But there are some strategies that you can see us about on how to diversify your taxes and do it the smarter way as you approach retirement.
Yeah, and taxable just means each year, pretty much.
It means give me my money.
Each year, you have a CD, even though you don't take the money out of the CD, you're still taxed on it. Tax deferred is later. Tax free is it's after tax. You already pay taxes on the seed rather than the harvest, as we like to say around here.
Yeah.
So here's, and I threw this one in here because this is something it's catching people.
It's sneaky, and not everybody knows this.
It's sneaking up. That's why we like to put a plan together, because you can't look at things in isolation. Did you know that once you start taking Medicare, you're paying for Part A and B from the government, and then you can get a supplement or an Advantage plan. But A and B, and then there's Part D is the drug plan. They are the cost that you pay the government is linked to your income in retirement. A lot of people don't know that. So they're like, well, I don't work anymore. I don't have a lot of income. Well, yeah, if you take so much out of IRAs, this is what's happening a lot with folks. They might sell an income property. Pops their income up. Maybe they hit somebody, they made $300,000 on something for a long, long time, gained 300, so 300,000 now it was capital gains, goes into your income. And then what Medicare looks at is the 2 years prior, what was your income then? And if it's over a certain amount, I think we have the table in here. Over a certain amount, your Part B, which is the doctor part, and Part D, which is the drug part, they go up, and there's brackets in there. And there it is there. Let's see. So Part B, if you look at the middle column, that's the doctor part. Part A is the hospital. So you don't pay for Part A. Part B, you do. So that's the doctor and everything else. And then the last one's Part D, which is the drug. Those two things go up based on how much income you have in retirement. So the standard, what everyone's paying now, if their income, if they're single, if it's 97,000 or less, or couples 194 or less, they're paying nothing extra for the drug plan, just whatever the premium is for the drug plan, but they're paying $164.90 a month for Part B. So that's the doctor part. But you always, again, Part A and B aren't enough in Medicare to cover things. You need to get a supplement or Advantage plan. But you have to have Part B before you can do that. So if you're paying $164.90, that's what most people are. But if your income goes up, the next row there. If you're single and it's 123,000, let's see, above 97 to 123, they add 65.90 to your premium
per month. And then it keeps going up. You can see the tables as your income grows, so does your premium.
And it goes up further than that. I just kind of cut it off there. But here is the number. I go back to this one. It's IRMA, it's called, and it's they adjust your monthly amount is what that is. The surcharge. For this year, 2023, if in 2021 your income single was over 97, or if you're married was over 194, you're going to pay more for Medicare. You're going to pay more.
So all the more reason to do some prudent tax planning, because it affects more than you think your income in retirement.
Yeah. And if you have a once in a lifetime kind of odd thing happen, you can fill out a form and fill it in. We've had a client actually
the house
was very successful in changing that so they didn't increase it. You can
so talk to us if you're in that situation.
It's good to know, and so many people, things are all interrelated these days. Okay, so will your Social Security be taxed? And we talk about that a lot in our Social Security classes and everything. But here's the deal. If you're just taking Social Security and you have no other income that's taxable, like you can have money in the bank or Roth IRAs and money's coming out of that, that's not taxable. If no taxable income besides just Social Security coming in, none of your Social Security will be taxed. But basically, the more you have of taxable things when you're taking Social Security, the more of your Social Security will be taxed. And here's the table, which we do go into a lot of detail in our Social Security classes, and come and ask us if you're not sure. But it's single and married brackets and things like that. So what they do is take half your Social Security for the year plus any kind of, plus your adjusted gross income, pretty much. And where does it fit in this table? And most people, if you're married and both your incomes and any kind of taxable income you have is over 44,000, 85% of your Social Security will be taxed. So today, it's not 100% of your Social Security is taxable yet. They're looking at a lot of different ways to shore up Social Security. You see on your statement when you get it, it says in 2033, 34 that there'll only be enough money to fund 75% of everyone who's taking Social Security that benefit. So they have to make some changes.
So it could go up to 100% of the amount of your benefit that could be taxed. That doesn't mean that it's taxed at 85%. That just means 85% of it is subject to the tax bracket that you happen to fall into.
Exactly.
So if you have questions about that,
and we follow that a lot. And there's a lot of proposals, both houses.
Yeah. Another moving target. Things they have to be changing. We don't know when.
Something has to change.
We don't know how.
That's one thing that could change.
We don't know when, but we know it's going to happen. It has to happen to keep Social Security solvent.
Yeah. So why do we show this table?
We show this table because we like to give some context for where taxes are today and where they have been in the past. We like to warn people about potential tax bombs. If you can see, the chart shows that historically taxes have been quite a bit higher in the past. It shows the highest and the lowest marginal tax rates for wage earners. And you can see back in the 40s, 50s, 60s, it was up above 80%. So we want to show that it's possible for the tax rates to go back up into those areas. We want to make sure that in retirement, not all of your income is taxable, because we don't know where this line is going to be when you retire. So we want to do a little planning ahead of time and make sure that we have some diversification, because this bomb means we don't know what the taxes are going to be in the future. So it's something that we can't foresee, but we can prepare with some diversification with Roth conversions.
Things like that, because we don't know. Say you have 500,000 in your IRA, we don't know how much of that you get to keep.
Right.
Unless it's in a Roth, then we know it's 100.
So we'll just talk about Roths real quickly. Does anybody have a Roth? There's a poll again on the right-hand side. Yes, I have a Roth. No, I don't have a Roth. Or why? Those are just for young people. You can chime in on the right-hand side. We've got a yes. Someone has a Roth. A lot of people think that Roths are only for young people because they haven't been educated about the benefits of conversions, and they haven't talked to their planner about whether or not a Roth conversion could be a good strategy for them. So we like to bring it up just to make sure that everybody knows that this is a strategy they can use. You want to hit this one?
I'll hit this.
Hit it.
Okay. Basically, it's like that first bullet says, it's a strategy to really spread out your taxable income in retirement. Because if everything is, if you have, like I said, $500,000 or whatever you have, that's all going to be taxed. We don't know what rate will be in the future, but if we can start doing some Roth conversions, maybe when you're not making as much money, because when you do a Roth conversion, you're going to take some of that money from pre-tax to after-tax and pay federal and state taxes on it. So it gets added to your income the year you do it. So you don't want to go crazy with that, but maybe over time slide some over. So, it's just something to think about, and also to at least to start one if you don't have one. So because they want you to have one open, which for 5 years.
Really
5 years, right? And you can always take out the money you put in a Roth the next day. If you want to take out any of the earnings, they want you to be 59 and a half and have opened it for at least 5 years. So we like for people to get one started if they can, to start that clock.
And you can start a Roth as a new contributor, and this coming year you can add went up to 6,500 if you are under age 50, 7,500 if you're over age 50. Those are new contributions that you can add every year, or you can do a conversion as big as you want. You can convert from traditional to Roth. Obviously, she said we got to make sure it makes sense so you don't pay more taxes than you need to, but conversions versus new contributions in Roths, two different strategies to fund a Roth.
Yeah, we like to try to keep it under, the maybe 12% tax bracket, maybe the next one. But, as you're doing a conversion that gets that plus any other income all adds up. And the more you have of income, it's higher and higher in the tax brackets. If we can keep it under 12%, it's not a bad idea to do some of that conversion right there.
Also, just keep in mind, there are income limits for Roth contributions of new money. We've had a few clients run into this tricky thing where they've always been contributing to their Roth all along, and then their career takes off and they start to make a lot of money, and then they keep contributing to their Roth and they don't realize that they actually aren't eligible. They're making too much money as an individual or as a couple, and then they have to go back and take that money out. So before you put new money into a Roth, make sure you get with us or your planner and make sure that you're eligible. Your income limits are eligible to contribute to a Roth. Because not everybody can add new money. Anybody can convert, but not everybody can contribute.
That's right.
Yes. Okay, handout. This is a cool one. We really like this sheet. We always hand these out to you guys. This one has a little more detail than the other ones we've done. On the right-hand side, you have a button to click the download. If you're watching the recording, you can send me an email and I can email this to you if you want it. There's a little glimpse of it here. It shows obviously the income tax brackets, the standard deductions, Social Security. There's a little box on capital gains. That's why we like this one. It has this info here. We're going to segue into capital gains and retirement per the request that we got. This little chart here shows that there's actually two different rates for capital gain taxation. I guess there's three. It's not all the same. It's based on your income, how much you're going to pay in capital gains tax when you sell something that has earnings. So did you want to?
Yeah, say a little bit. So capital gains, if you say, for example, you sold an investment house and you had 100,000 of gain, that gets added to this. Well, it gets added to your income. So I think most people would probably fall into the 15% capital gains. Of the gain that you have, 15% of that you owe taxes on. But if you didn't really have any other income, say you sold something, a house, and it was 30,000 that you gained, and you really didn't have any other income, you had cash in the bank or Roth, you're getting money from or Social Security, and you were under the 44,625, you have no capital gains owed on that 30,000 that you might have gotten from a property or something like
But that's
that. Or
assuming that you have no income.
no other income, as long as all your income combined is under 44,625 after you do that sale. It could be a sale of stock that you've had for a long time. As long as it's under that, there's no capital gains on that. And then most people would really fall into the 15% of the gain part would be taxable, and then there's the 20% for the high income. So that's single and married numbers in there. So retirement accounts, IRAs don't have capital gains because anything that comes out of a retirement account is all ordinary income taxes. That's the other regular ordinary income tax brackets that when we do our taxes we look at. And then one thing to look at the end of the year, which we work on with our folks on, is tax loss harvesting for non-retirement accounts. So if you have a joint account or individual account, you have big gains and you have some losses, instead of that were sold and locked in, realized we call it, you can, say you had a lot of gains and there's some things in there that has some losses, we can sell those and offset some of the gains so you don't pay as much in capital gains taxes. So that's something we help everyone with.
And there's lots of strategies to address capital gains. If you know someone who is facing a high capital gains situation, maybe from selling a property or from selling some sort of investment, have them come talk to us, because there's ways to decrease and even avoid or postpone capital gains tax based on the investment that money goes into. So
we do things.
Strategize with it.
Yeah,
with real estate.
Opportunity zones and 1035 exchanges for real estate. But there's capital gains on anything you can put in an opportunity zone. It could be anything, stocks or anything. So there's a lot of strategies out there.
There's ways to postpone or decrease it, and just there's strategies that go around all of our tax filings.
So here's something that's a permanent thing that wasn't when it first came out. But if you are older, you're 70 and a half. See, that was, when this came out, that was when you had to take RMDs out. Mm-hmm. That's why it's 70
just
and a half.
trying to trick us.
Yeah, but so this didn't change, though. The RMD age went up, but this did not change. So when you are 70 and a half, if you wish to take money out, directly give it, not to your account, but directly to a charity, you can do that up to $100,000 a year and you will not be taxed on it. So if you're going to do that anyways, instead of you taking it and then give it to a charity, you'd be paying taxes on it. If you give it directly to a charity, no taxes, no income tax.
It's a good way to increase your gift, because obviously they get the gift and the tax money that you would have paid, or you get to keep the tax money, so you get to be a little bit more efficient by giving this way. And you can satisfy later part of your RMD with this.
Yes. Yeah. That's the main thing. It was if you didn't really want to take money out from your required minimum distribution and you had to, you could do this.
So if you're 73 and you have an RMD coming due, this is a way to satisfy the requirement and not have to pay the tax.
Right.
If you don't need the income, you could give it directly to a charity this way.
That's right.
Okay. This is cool. This is some new stuff here. State of Colorado, how to minimize your Colorado state taxes.
Yeah, so this is all just Colorado based, as it says here. So if you are interested in 529 plans, or if you have one, or if your kids have one, or grandkids, or anyone like that, if you give to the state of Colorado's 529 plan, you can deduct that off of your taxes.
I don't think I knew that. I don't think I did that this year. So again, it's called called College Invest. If you Google College Invest, it'll come up. It has to be the Colorado state fund plan in order to qualify for this deduction.
Yeah, and they have several. The College Invest is the one that you don't pay an advisor for. You do it on your own, and that's what we help people get involved in. That one, we can direct you through and help you. I think they call Scholar's Choice is another one where you pay someone, which you don't really need to. Really, I don't think so.
Depending on how much money you have in there, I guess.
Yeah. So, but we can help you set that up. But anyways, so you don't pay Colorado state taxes on the money that you put in one of those. So you could put it in for anybody. It doesn't matter who it is. If if that's the contribution you're giving to a 529 plan for the state, our state only. That's why there's a tax incentive to do our state plan. You cannot do that if you do one in Texas or something. Every state has a 529 plan. Okay, so this this is, I think a lot of people probably know this one. If you are, this is the state of Colorado, and I was looking at, there's a handful of states that have no income taxes. A lot of people know that. Wyoming, Texas, it just goes on and on. But we have a benefit too with our state. So if you are, there's two brackets, of course. If you are 55 to 64, the first $20,000 of retirement income is excluded from the state of Colorado taxes. And I'll show you, there's a form. I'll show you right where it is on this form. It's called a subtraction form that you write that on there. And if you are 65 or older, it's 24,000 of retirement income is excluded. So what is retirement income? It is pensions, taking money out of IRAs, Social Security. It's really pretty much those. 403Bs, any of the retirement plans that are out there.
So it doesn't include wages if you're still working?
Right. Yeah, because you're supposed to be, no, it's retirement plans. Right, good question. But what they changed last year is, what if your Social Security was greater than 24,000? And I kept hearing in the news they were working on this. What they changed is there's no limit. You don't pay taxes on any Social Security, no matter how high it is.
In Colorado.
In Colorado, it's just the state. So there's no taxes on that. So if your Social Security benefit was 30,000, it's over 24. It doesn't matter. None of it's taxable.
So if you're a millionaire and you have the highest Social Security benefit possible, are you paying Colorado state taxes?
You're not paying.
No Colorado state taxes on any Social Security for anyone. Woohoo!
Yeah.
Party.
Yeah. So that's new, and
that's cool.
It's helpful anyway. Some of them, and you'll see that on the tax form. Then there's, I think a lot of you folks know this one too, the senior property tax exemption. It says reinstated. It doesn't work every year. It started a few years back, and for about 3 or 4 years they didn't do it. They didn't have the money. But they do now for 2022. So the whole thing here is you can get a break on the value of your house. They'll take off up to 200,000. I guess I didn't say that on there. I don't want. Okay. If you're 65 or older, the first day of the year, and if you've lived in your house 10 years at least, then they'll they'll take off up to half of the value, up to 200,000 value of your house. So the taxes will be less because the value of your house will go the max. They'll subtract 200,000 off of that.
Okay.
So that's
less property taxes if you're over 65, up to minus 200,000 of the value if that is half, or whatever is greater, half or 200,000.
Yeah, and that's what I just saw, because it used to be
That's
100,000, and I just saw it yesterday.
So we're saving money on property taxes in retirement. Nice.
And they said we're going to all get shocked when we get our statements for the property taxes are based on a year or so ago, so they're going to be going up.
We're all going to be shocked because the property values are going up so much? Because
the taxes are going to be up so much, even though they've come back down a little bit more this year. But and that was on the news this morning.
Yay! Well, you can always contest it, I guess, if you've got the energy.
Yes, you can.
Here's that form.
Isn't that exciting?
Where did we get this form? Where'd you get it?
It's on this colorado.gov.
And you would put this in your taxes?
Yeah, so this is subtractions from income schedule. And if you have someone doing them, they know this, but you need to have this schedule. See, it says number 3 is primary taxpayer Social Security benefit. You can put that on there. And then there's also one, number 5. That's for Social Security, to put that in. Again, it's up to, if you're over 65, up to 24,000 coming off of there. And also number 10, college invest contributions.
That's the one I missed this year. Son of a gun.
Well, didn't
I don't think she didn't ask me how much I contributed, so I think I missed it. But next year, I'm going to do it.
Yeah.
Cool. That's wrapping it up, guys. Today we talked about tax reduction strategies, obviously, but this is what we like to include in our pie. The complete comprehensive pie has investments, income planning, Social Security, estate planning, and tax reduction strategies. Tell your friends. You guys all on this call, I think, are our clients, or you know us pretty well. Tell your friends if someone needs planning like this. I've got a link here I'm sharing. This is a link to our calendar. We have a Calendly calendar that is often displayed in our emails and in our actual emails and the emails I send out. Feel free to share it if anybody you know needs to talk taxes or wants some help with their investments or wants a comprehensive financial plan. And thank you for coming. Does anybody have any questions? If anybody does, you can chat them in. While you're thinking about that, I will mention we're going to move this format a little bit. We're going to stop doing scheduled topic classes, and instead we're going to move to regular updates. So we're going to do live webinars like this, but instead of having a very specific topic like Social Security or taxes, we're going to have more of a general conversation about what's going on in the world, in the market, and what sorts of things could be affecting your investments, and just give more like a quarterly market updates. So look for the emails for those. We're excited. They're going to be a little bit more relevant, a little fresher. We're still available for these kinds of topics. If you need this information, I have lots of recordings, and we'll probably do some specific classes here and there, but not like we used to, just trying to mix it up a little bit. So
yeah, and the things that they're looking at in Congress.
Yeah.
There's a lot of things out there, a lot of different topics with WEP and GPO, all these other things too that we'll bring up. Anyway,
we're going to try to keep you in the know over here and make sure you get all the information that can affect your money so we can plan ahead.
Yeah, super.
Okay, well, you guys are awful quiet today. I know there's kind of a small audience, but thank you so much for showing up for us today, and have a great rest of your day.
Have a great weekend. It's going to be warm.
I hope so.